Hello, I'm Majun from the American Stock Exchange University. Let's start today's United States stock news on April 7th. We welcome you to Majun, who is consistently maintaining the stronghold of United States stock investment even today. The United States stock market is facing the worst situation. So actually, I have something to do in London today, so I don't have time to broadcast. Even though it's a very short video, I thought I should send you a brief understanding of the current market situation and what my personal plans are, so I turned on the camera. First of all, if you look at the S&P 500 index, last Friday, a sudden situation occurred again. So on Monday and Friday, we are experiencing the worst situation where the United States stock market crashes for 2 days in a row and cannot get out of the red throughout the week. Well, so today. Now I want to read a piece I wrote in front of the broadcast to you all, and the title of this article will not be different this time. So to summarize, I am currently going through a very difficult time emotionally. Well, how do you endure such a time? The history of the United States stock market will ultimately repeat itself, so I believe this time will be no different, and I am holding on to United States stocks with this belief. That's how you should see it. From the perspective of an investor who can't predict the future, we don't have the ability to see the future, so it's an incredibly frustrating situation. So what can our investors use at this point? In the end, investors have their own feelings. We usually go by our gut, so we can either invest based on our feelings or trust historical statistics. We have these two options. And personally, I am investing while trusting historical statistical numbers rather than my own feelings or emotions. You can see it like this. So today I want to share two historical facts with you all. The first one is that the S&P 500 has only fallen by 45% or more in a row 4 times in the history of the United States stock market since 1950. So it's a bit difficult to see, but this happened last week. You can see it like this. Well, it's shown here. There was an incident in October 1987, and then there were 2 more in 2008. And then there was an occurrence on March 12th, 2020 during the pandemic period. And the last one happened on April 4th, 2025. The important thing here is that we can probabilistically determine how the United States stock market will turn out in the future by looking through the past. But as a result, I can deliver extremely negative news to all of you. If we look at the trend after the next 12 months when such a drastic drop occurred, the United States stock market had a 100% chance of rising. The average stock return was a whopping 34.3%, and the median of the winning rate was 33.9%. The stock price increase rate averages 6% after 1 day, 6.5% after 2 days, and 4.6% after 5 days. Therefore, after the stock price exploded for 2 days in a row, overall, whether viewed in the short term or long term, the United States stock market's history has shown a positive trend. I'm able to present this first statistic to all of you in this way. And the second one is the proportion of stocks that are currently being traded above the 200-day moving average among the 500 major companies included in the S&P 500 index. This has now fallen to 23%. Now, 23% is a very weak number. So, 77% of the majority of stocks are now below the 200-day moving average. Now, after 1990, when the proportion of stocks traded above the 200-day moving average in the S&P 500 companies fell below 25%. So, we look back at the historical statistics to see how the United States stock market performed 12 months after that. And the probability of it going up was 77%. The average rate of increase was 14.5%, and the median rate of increase was 17.9%. And one more thing. When we looked again only at the last 10 years, the results were even better. As you can see, the probability of the stock going up was 100%, and the median increase was 20.8%. And on average, the United States market increased by 22.5%. And I will conclude by adding just one more thing. In times of stock market crash, it feels like the downfall of the stock market continues endlessly. This is the feeling I was talking about earlier. Our feelings speak like that. However, we must remember the fact that we felt the same way even when the stock market was rapidly rising. Just 2, 3 months ago, we felt as if the United States stock market would continue to rise. Therefore, it can be interpreted that we need to remember that our senses were wrong at that time. This is because in stock investing, you predict the future. There's nothing certain, but there is one thing that is certain. Just as you can't predict the peak of the stock market, no one can absolutely predict the bottom of the stock market. You need to remember this part. And from my experience and memory, the rebound of the stock market always started at a time when it seemed logically impossible. For a vague example, it was the same in 2020, and in 2022, I had a feeling that this downturn would last at least 6 months. Everyone knew that the pandemic would last more than 6 months. And the bear market, where the stock price fell as the interest rate rose, it was the same in 2022. We all knew that it would take at least a year for the interest rate hike cycle to end. That's why even if this bear market continues, it's likely to last for about 6 months. This was the expectation that everyone had. So the plan was to sell everything now and re-enter when it falls further after 6 months. A very logical plan. But the problem is, such logical and rational calculations and plans often led investors into despair. So logically speaking, it makes sense, but we need to remember that the stock market never moves logically. Last Friday, the distribution rate soared to 50.93% in a single day, now ranking 45.3. Yes, and as we can see in the graph below, since 1990 the VIX has exceeded 45 only twice. Yes, we've currently surpassed 45 here. But when we look back at history, there were only 2 exceptional cases. This was recently in March 2020. One was during the pandemic, and the other was when the 2008 global economic crisis hit, exceeding this level, as you can see. There is one question we should ask ourselves in this context. The question is, to what extent the Trump administration, which is causing this surge, has an impact on the United States economy and market compared to the past pandemic and the Lehman Brothers incident. And it is a problem that we as investors have to judge for ourselves. This is what I want to say. Personally, I believe that the level of fear this time cannot be compared to the intense fear of 2008 when I lost my job, and the pandemic period when the whole world was gradually cut off. Of course, I might regret saying this a month from now that I should have sold my stocks even a month ago, but at least after about a year has passed. Looking back now, I can confidently say that the decision to hold on to my stocks was not wrong, and I am overcoming these difficult times with this certainty. I was able to share my personal thoughts and plans with you all today. That's all the content I prepared for today. It's a tough situation, and I apologize for not being able to broadcast for a long time. Instead, I would like to share one more video with you. This time the video is an interview with Professor Jeremy Siegel of Wharton University, who appeared on Consumer News and Business Channel News. It would be good to listen to what this globally renowned investor has to say about the current situation and what message he's conveying to investors. I will try to greet you all again tomorrow with a slightly longer video. We will all fight together until the day we retire from investing in United States stocks. Have a happy day, thank you.
I'm not sure if my voice will be clear this morning, but when considering the situation arising from this tax, do you think the market will recover soon, or will it continue to decline?
First, I would like to mention the smartwatch tax you just mentioned. I think this is the biggest policy mistake since 1995. The interesting thing is, if you go to the Senate website of the United States and look for the tariff, it comes out like this. On June 13th, 1903, the Senate passed the Smoot-Hawley tariff, one of the most controversial bills in congressional history. In the Republican-dominated Senate, 1,000 economists sent letters to the future president urging him to veto, but the future president did not veto. And the result, in their words, was disastrous. The United States suffered a catastrophic result to the extent that it ousted the Republicans from the presidency of the Senate 2 years later. Frankly, the economy made a big mistake as it collapsed after that year. Because of the lessons learned, we will not do such a thing again. I don't know why Trump didn't learn the lessons of Smoot-Hawley's tariffs, knowing that the economy learned its lessons from the mistakes of 1903, 1931, and 1932. This is one of the reasons why the gold standard did not lead to a Great Depression. 25 years ago, we handed over volatility that we didn't have to the banks. But frankly, I wouldn't be surprised if President Trump removed this clause from the Supreme Court's website. Why? Because this is good news. I think the Fed should lower interest rates in response to this global shock, as I believe it will. Inflation is almost certain to rise. However, it's a systematic error, meaning it can't be controlled as precaution. There was no need for this to happen. It's a shock we've created ourselves. Powell said in the March Federal Open Market Committee meeting that he would keep an eye on the impact on inflation. There may be those who oppose, but in fact, I initially thought that there was no possibility of a rate hike in May, but now I think that possibility has increased. If there is no drastic turnaround on taxes, that's it.
As you were saying now, the Dow Jones continues to fall, and we need to focus on the fact that it is currently close to a 1,000-point drop. Even just 15 minutes ago, the decline was about half, so the speed has increased. In the situation where the Chinese Ministry of Finance is mentioning the possibility of a bailout, the core question is how effective it can be to complete what appears to be a man-made disaster, even if the interest rate is low, if it is opened. That's what it is. Do you see this as a market that has value to own right now, or do you think there's a possibility of further downside if the current trend continues when considering the situation that's happening now? Should we continue to invest in this market? Is everything on sale? Honestly, I don't know. Long term.
As an investor, it's good to stay in the market. I'm the same. If you're a trader, a bull market is expected in the future. This is a maintained perspective. The event that happened 10 minutes ago, in other words, the nightmare scenario of a recession has become a reality. Remember, today, the role of trade in the global economy is far greater than when the Smoot-Hawley tariff was established 95 years ago. Therefore, its impact could be exponentially more serious. Because 95% of the time the market is range-bound, I don't recommend making big moves right now if you're trying to time the market. If you're a long-term investor, you should know that such a perspective is ultimately not sustainable. Surely brighter days are ahead. The United States economy is fundamentally expected to remain the most dominant in the world over the next 20 to 30 years, as it has been.
You've indicated that China's response could potentially lead to a worst-case scenario. The bigger issue is whether it could prompt other countries to take the same actions.
We don't know if that will happen.
Nobody.
Wouldn't you want to go first? Yes, because China moved first. Other countries could hesitate. As you said, many European countries are adopting the attitude you're worried about. When all this is over, who will know? Trump may have to wait until the opinion poll on this comes out. The opinion poll doesn't seem to be favorable.